When you're looking at buying your next home and securing that mortgage, you might have the option for a lender credit. You might get some extra money to put towards that home and towards the mortgage, but in exchange, you're going to have a higher interest rate. Is it worth the trade-off? Today, we're going to talk about a couple of different scenarios where it might make sense, might not. We'll get Bill's opinion on that. He's going to share an example of someone he recently worked with. Welcome into the Smart Mortgage Show. I am Ben George with Bill Litton at Cross Country Mortgage. He is regional president there. Find him online, smartmortgageshow.com. So, Bill, we talk about a lot of different aspects of the mortgage. I wanted to talk about the lender credit today. And kind of as we get started here and trying to determine whether or not it makes sense to take our lender credit, kind of explain how that works. What is the home buyer getting in that process?
Yeah, so a lender credit, Ben, is basically that the lender, that would be us, we are going to give the buyer or the borrower, whether they're buying or refinancing, a credit. We're going to give them money towards their closing costs. Okay. So as you've mentioned, typically that does require, I'd say 9 times out of 10, the interest rate's going to be slightly higher, which that higher interest rate actually creates the credit.
Okay, makes sense. What is just before we get into it, what is that 1 time out of 10 where it doesn't affect the interest rate?
So I would say sometimes when the loan amount is large enough that, the size of the loan will allow the lender to give a credit without adjusting the interest rate, because it's kind of like, the larger the purchase or the larger the sale. If you're selling your house, if somebody's selling their house and it's worth $100,000, most real estate agents would probably charge 6%. But if it's $3 million, you don't need to make 6% on $3 million, right?
Right.
So due to the sheer size, the volume of the loan amount, there's actually extra money in the loan amount where you don't have to raise the rate.
Okay. So for the vast majority of home buyers, that's not a situation they're going to address. So let's talk about then exchanging that lender credit for a higher interest rate. And before you kind of answer that, is a lender credit available to anyone, Bill? Is that an option for anyone that's buying a home, or is it in select circumstances?
Yeah, I would say it's not available to anyone because, for one thing, if your debt ratio can't handle it, right? As we increase the rate, we increase the payment, we increase the debt ratio. So a lot of times there's debt ratio restrictions. The other scenario is, believe it or not, the lower the credit scores, the less lender credit they would give back as you increase the rate.
Okay.
So if your credit score is, 620, we could raise the rate a whole percent and you're not going to get much benefit. Where if you're 780, if we raise the rate a whole percent, you're going to get a decent amount of money back.
Okay. Very good explanation. All right. So let's talk about when it makes sense to take that lender credit. Because I think a lot of people would say, well, I don't want that higher rate. If I can keep it down half a percentage point or whatever the difference is, I'd rather do that. But sometimes it does make sense. So walk us through how to determine when it's the better option to take that lender credit.
Yeah. So recent scenario that I am working with a customer, and this customer is selling a house and buying a new house, but they're actually going to buy the new house before they sell the old one. Okay. So when they sell the house, the existing home they live in now, they're not exactly sure what they're going to do with the funds, but they're relatively sure of one of two things. Either rates are going to be lower in the future, or they are going to pay it off within a year. So what we did was we structured the loan where the rate was about 1% higher, and we gave them $10,000 back towards their closing costs. So now they save a true $10,000. But the trade-off for that is that the payment is $200 higher per month. Okay. So 200 times 12 months is $2,400, right? So if you take the $10,000 that they saved up front and you subtract the higher payments equaling $2,400, they still save $7,600 in the first year. And they're committed that they're either going to pay the loan off. They have the facilities to do it. When they sell their house, they're going to have the money. Or they feel relatively sure that they're confident. They know the market a little bit. They think they're going to refinance. So they're not worried about that now, if they said, hey, we're keeping this loan for 10 years, that would make zero sense.
Gotcha.
Right. But in this case, they have a 1-year time horizon with that loan. The most that loan can hurt them is $2,400. They save 10 up front. They pay an extra 24. The savings is $7,600. Client was very appreciative of that, kind of creative solution for their specific situation.
So if you're someone that's just looking very, very short term and just saying, this is an option for me to not have to put as much down at the closing table, save me a little bit of money that I'll have in my pocket afterwards, that's probably not the best reason to be doing it.
Yeah, I think that if you're not sure about refinancing, if these tend to be more sophisticated home buyers. They've either owned a home or two. They kind of been down the road. They understand. They have the resources to pay off the loan if it continues on too long. There are situations where I've had people that say, I could either rent for another year, which is certainly a loss, right, in a lot of ways, or I'll take the lender credit just because I don't have the other $10,000. And that $10,000 actually helps get them in the house. When we compare that against renting, that's a better situation most times than renting.
Gotcha.
So in that situation, we would say, even though they might have that loan longer than 1 year, now they own something. Now they're amortizing the loan and the home's appreciating, and et cetera, et cetera.
Okay. With these lender credits, let's just say right now rates are 6.5, and let's just say by the end of the year we're under 6. Let's just say 5.75. Just a pure hypothetical. How quickly can you turn around after getting a lender credit and refinance? Can you do it within a year? Are there rules that are tied into that lender credit?
Yeah. So technically, you can do it within a year, no problem. Most lenders, almost all lenders, most of the loans that we have, there is no prepayment penalty. But if the borrower pays off the loan before they've made 6 payments, then we actually have to give our commissions back and actually pay a little fine. So we prefer that, we want to make sure that when we're employing, in fact, any loan we're writing, we want to make sure that the borrower is going to be able to make 6 payments, because if they don't intend on making 6 payments, that would, we would put all the time, energy, effort, work, expenses into making the loan and have to give it all back.
Interesting. Didn't realize that. All right.
Yeah.
Well, good stuff. So lender credit, again, something to discuss with your mortgage lender. Bill Litton's happy to talk through those options, see if you have it, if it makes sense for you. At Cross Country Mortgage, you can always get in touch, smartmortgageshow.com. Check out all of our past episodes as well there. And if you haven't subscribed yet to the channel, please do so. We'd appreciate that support. Bill, as always, pleasure catching up with you. We'll talk again soon.
Thank you so much.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.